So my name's Luke. I'm tax director of Gravitate, as Sam mentions. I've worked in tax about 15 years. Originally trained up as a chartered accountant, specialised in tax probably for the last 10 years. I cover personal tax, owner-managed businesses, VAT, inheritance tax. So I cover quite a broad spectrum. So sometimes people in tax will work very narrow in one sort of area, which is quite frustrating for clients sometimes, because if you've got a project that covers 3 or 4 bases, you may have to speak to 3 different people. So the benefit that we've got at Gravitate is I can cover a lot of the bases, which makes it much easier for the advice reports. And the presentation today is obviously going to go through some of the main triggers that we see frequently with clients that are referred into us, or new client leads we get from, say, Google, or just in terms of chats we have with some of our finance directors who lead the teams. You want to jump to the next slide?
Yeah, there's a quick disclaimer.
Yeah, this is the BBC disclaimer saying that this is high-level general advice, which is not specific. So if we were doing any actual tax advice for any of our clients to any level, we would always make sure that we've got all the facts in place, set out engagement terms, etc. The reason why obviously we do that is it's quite easy to give informal advice, not knowing all the facts, which can, in some cases, scupper the whole prospect of what you're trying to achieve, essentially. Okay, so number one, the one that we probably see more often than anything, is the need to incentivise and retain senior management. This could come from a firm of any size. It could be that you've got, I don't know, one founder and a couple of employees, or you could have one founder and you may have built up to Gravitate's level where you've got 30 employees. Essentially, it's where you have a senior enough employee where you really need to tie them in, and it may not just be possible to just do it on a combination of salary, benefits and bonuses. The reason for that is obviously that if you've got a really good member of staff and that's all they're tied by, if they move elsewhere to get the same package, they've got no real skin in the game. So they can leave. Obviously, if you lost them, there's the cost to consider just from a basic cost benefit analysis perspective, which might include recruitment fees, loss of expertise in the area that they may be involved in day to day, and it may even be, depending on the roles that that person does, they may leave with client relationships and you may lose contracts. Obviously, from a legal aspect, you may try and protect that, but we've probably all worked in businesses where that may have happened. Other things to consider if staff members leave is you've got things like devoting management time, supervision, and essentially getting that new member of staff to replace the one that you've left through the learning curve. And as Sam was saying, when obviously I joined, it took quite a while to find me. So on the same basis, if the person is quite niche, it might be a few years before you find an ideal replacement. And we generally say, in cases such as this, that we look at it as the investment in the scheme is an investment rather than a cost. Essentially, the main options that we see and we would advise on is founders looking to give either free shares to senior members of staff, growth shares, or what's called EMI shares. And I will run through all 3 of them. So free shares would be as simple as Sam deciding to bring in another division into Gravitate and deciding to give 10% of those shares to the new person. Obviously, the shares in the business that Sam would decide to give have got some value to them. So generally speaking, that's quite an inefficient operation, mainly because if those shares are worth £100,000 and they are passed to me as a new employee, that value is taxable on me as employment income. So I get a tax charge straight away, which I've got to pay out of no money because I've not had any cash. I've just got shares that are worth a value. So generally, free shares are quite inefficient, but it's sometimes the start of the conversation. Sam might say, we want to get someone on board, we want to give them some shares. Giving them free shares is probably not an ideal option. It will depend on, obviously, the size of the business and the proportion of shares you want to give. Obviously, we've got a few on at the moment and the free shares maybe 30% of the business. Obviously, on a multi-million pound business, that's going to be a huge number. Alternatively, if we've got a small startup and they're looking to give 1% of a very small number, obviously the scale's completely different. But on every conversation we have with clients regarding incentivising management, we will obviously scope all 3 out. Growth shares, for any of you that have not heard of them before, are essentially a type of share where you will not necessarily receive an equal proportion of the business. So what you will have is you may have a percentage holding in the business, but that will only kick in above a certain hurdle value. So if we use an example, because we do use growth shares, don't we?
Yeah.
If you've got a business that's worth, let's say, £500,000 and you introduce a new person to the business, you decide on where the hurdle value sits. So let's say, for argument's sake, you set it at £1 million. The new person joins and they may get 10% of whatever is above this hurdle value, essentially. The debate on that is the shares are obviously worth less with a hurdle in them than if they receive 10% of everything. But obviously the value will depend on how high the hurdle is relative to the value. Years gone by, people would do growth shares based on what the value is today. The revenue are quite active at pushing back on that and saying we think there is value immediately. So there are risks with growth shares in terms of it's quite an extensive operation to value the business and then value the sort of future forecasts. But they are a very good alternative to free shares in that the shares that are given have got a much lower value. So the person that receives them may receive shares that are maybe only worth £1 each, rather than if they were just free shares, maybe they'd be worth £100 each. So obviously the tax implications are much more reduced. The debate on growth shares is essentially, and we've had one recently, is if the business is worth £1 million and you have to set the hurdle at £3 million for there to be no value in the shares, from the employee's perspective, that can be quite disincentivising, because they can then think, well, we've got to triple in size before I get a stake. So it's sometimes a bit of a balancing equation, essentially, to decide how low do we want to set it to keep them incentivised, but not too low that there's too much of a tax charge. There are options in that. So you can do it where you set it at a lower limit. When the employee's got a tax bill, you may decide to clear it with a bonus. So there are sort of options to do. Obviously, that will add more cost onto the transaction. But again, going back to the points above, if ultimately you include it as part of the investment in the transaction to ensure that this person doesn't leave, it may be the necessary evil to make sure that they're the most incentivised to grow the business, or they're part of the business, whilst also minimising the impact on the business and the individual. Third and final option then is something called EMI. So that's Enterprise Management Incentive Scheme. So that is a HMRC approved scheme where essentially the scheme involves agreeing a value of the business with HMRC and then drafting what's called option agreements where named people can buy shares in the business for a pre-agreed price. So for example, if we had a business worth, I don't know, £1 million, we may be able to agree with the revenue what the value is. We agree that for EMI purposes, some new shares may only be worth, let's say, £10 per share. The revenue would either agree it or push back and eventually come to an agreement. That employee can then buy shares at that price over a specified window. So it may be between years 3 and 10. You could put criteria in where certain performance criteria needs to be met, i.e. customer satisfaction, gross profit, any basically metric that you want to add. The beauty of that is that you can agree the price now and that price may be paid by the employee later on. The benefit being, if the options are worth £10 per share now and an employee works for you for 5 years, if when they come to exercise them, if the shares are worth £500, that's a massive incentive to keep them there, because they've not had to put the hand in the pocket straight away, and they can see later on when they buy them that they've already made a huge amount of money on them. So EMI is normally an absolutely great option because it's low risk, because the revenue agree the value. The values that you can get are usually very low and very beneficial because HMRC very much likes the scheme being adopted. There's protection for the employer and the employee in terms of clawbacks, etc. And from a financial perspective for the employee, they're the most beneficial in that they can delay payment as late as possible, essentially. So they are a great scheme to use. The only caveat with EMI is that the revenue give strict criteria of what you need to do to be able to meet the scheme. So as a very easy example, certain trades are not allowed to join the EMI scheme. accountants being one. So if we were to introduce new people into the business and we needed to look at equity, EMI would not be an option for us. Other trades that are excluded are things like hotels, lawyers, property development, and a few others. But essentially, if your trade meets the criteria for EMI, it's a good one to consider. There are criteria on the person as well that may get the shares, and there is criteria on the company for other matters, such as, for example, company size. Generally speaking, they are quite large. So there's an employee count, for example, of 250. Has anybody got more than 250 staff in here? No? So, and the asset limit, I think, is about 30 million. So generally speaking, if the trade criteria applies for EMI, it is a really, really good option to consider. Okay, so we've got quite a varied layout then. So generally with property, when we're speaking to other clients or, again, external clients or internal clients, we would say there's quite often potential tax work if a client's looking to buy, refurb or extend a property. The reason being, there's a lot of potential tax relief within the costs that can be potentially claimed, depending on how it's structured, who incurs the cost, and whether you own the property now or if it's, say, leased out. That could be, so if you've got a business where you own the property currently and you need to do an extension, you may get a builder and they may say, right, it's going to be £300,000 for the extension. And sometimes what you'd get is the builder would just say, they'd just be sort of stage billing and you wouldn't get much of a breakdown and you'd just pay in instalments. We can get surveyors involved to essentially analyse those costs, or what's normally optimum is if we can get the builders to kind of break down what they've done, i.e. like the offices we're in, sort of partition doors are so much, new heating system so much, flooring, mezzanine floor, aircon, do you know what I mean? If we've got components like that, we can work through which ones are claimable under which schemes. Quite often it is overlooked. So sometimes I've seen it where there's been sort of over £1 million deals where it's completely been missed. That can have big implications, especially if you don't do the claim. You don't get as much if you do it later, and if you later sell the property, it can be lost altogether. So it is always worthwhile, if there's ever going to be a significant spend, drilling down and just checking if there's any tax potentially at stake, and often there is. The other thing with property is if you don't own it now and you're looking to acquire property later, the main question is, or from a tax perspective is, who's going to acquire the property? So it could even be the shareholder or the founder that buys the property themselves. It could be the trading business. It could be a separate property business. It could be a group company if you're in a group, or it could be a pension fund. They're sort of common examples that we have. There are sort of pros and cons to all of them, depending on the exact scenario. But the main one that we see probably is often that the trading company will be the first one that people would want to proceed with. It'll be, right, I've grown my business, I'm currently letting, we've got a lot of cash, so we want to buy the property and we can get a mortgage. So that can be a good option, but what we always consider is if that business struggles later on, for whatever reason, the economy might have a downturn, or there might be a change in the sector, or there's a litigation claim. If anything happens and there's a property in that trading business, then that asset is at risk essentially in future. So what can be beneficial sometimes is if the property is owned by another company in the group, that then can ring fence that asset should the worst happen. The other reason that it's sometimes beneficial to do that is we see a lot of clients who've done that. They've built a company, they've bought a property in the company, they've grown it for 20 years and then they come to exit. The buyer of the company doesn't necessarily want the property. The reason being is if the trade's worth, I don't know, £2 million and generates £400,000 per annum, the buyer is happy to finance that because they've got a return. Whereas the property, if the property's worth £2 million, that bumps up the asking price by 2 million, but they won't necessarily get another 400 grand per annum. So a lot of the deals we see, they want the trade, but not the property. So if you've got a deal where, and I had this in a previous job, where we had a client looking to sell, they were adamant that because they weren't selling now, they didn't need to do anything for tax. They had a property in the company and they were adamant that the buyer would buy it. They got to negotiation stage, the buyer didn't want to buy it, so then they had to get the property out of the business. Doing it prior to a sale is incredibly expensive because it's essentially at the very least, it's usually a dividend of the value of the property. So in that case, it was about £1 million a dividend, which was going to be a fortune, plus stamp duty, which was a fortune. Instead, we had to do a transaction called a demerger, which was still really expensive, but just not as expensive. And it would have been far easier to have done it earlier or to have planned better earlier on. But obviously, there's only so much we could have done, which is why if we ever get any leads about property, it's very much a case of you've got the plan, but let's kind of go through it in detail. The best one I can kind of give is there's a business in Sheffield that I acted for in a previous role, and they asked a question about the VAT on buying a property. We asked a couple of questions, and it turned out that they were trying to buy a property that they were letting. Somebody else wanted to buy it, and they had first refusal. They had a plan to finance it. The finance wouldn't have worked, so we found out where all the problems were. They were going to buy it in the trading company, which would have massively been a risk later on if they'd have ever had any difficulties. So we completely ripped up the plan, did it in a new way, put some of it in a pension, some of it in a holding company. And it was probably the most optimum position overall. And in terms of the taxes that I'll mention in a second, the taxes we saved was probably about £200,000. So it was incredibly worthwhile doing it, even regardless of all the other non-tax benefits in terms of the security and the risk and the future issues if you're trying to sell. So it was massively beneficial. But going back to Sam's point, is the advantage that we had there is we had regular touch points with the client. I've seen it too many times where that happens, the transaction happens, the client proceeds with it, the accountant picks it up at year end, and then it's like, we could have done something, but we can't retrospectively do anything. And often that's really annoying from a client perspective and an accountant perspective, because we wanted to add value when we couldn't, and the client's annoyed because they knew they could have had the value, but you know what I mean, nothing, the stars didn't align essentially. So yeah, if we ever get anything like that, we'll jump on it straight away. And in terms of property in general, so within property transactions, there's often VAT implications, stamp duty, land tax, capital allowances. They're the main three. So VAT, I think everybody's aware of that, generally 20%. A lot of commercial properties have got VAT charged on them. The reason why that is an issue is that stamp duty, land tax is chargeable on the consideration inclusive of VAT. So if you've got a business that's worth a property worth £1 million, if there's VAT charged on the property, the stamp duty, land tax bill is 20% bigger because the consideration is higher than it would have been. There are certain ways to structure a property deal where you can essentially eliminate the VAT, which then has a massive saving on the stamp duty, and also a big saving on cash flow, because if you'd have bought it originally, paid the VAT, and then had to claim it back later over 3 months, and you can guarantee that the revenue will ask questions and delay the repayment. If you're using bridging finance for 6 months, which might be 2% per month maybe, plus a setup fee, it's going to be quite costly on the size of transaction that may happen in a commercial property deal. So normally that on its own is massive. Capital allowances are essentially part of what I mentioned earlier in terms of the lighting in the building, the aircon, the kitchen, fire safety systems. There's certain items in a property that you can claim tax relief on, but a lot of it you have to do it at the point of the transaction. I.e., if you're buying a property, you have to do it within the discussions with the solicitor. And sometimes, depending on the solicitor, they won't reach out to the client or the client's tax advisor at the time. And then again, we get to the deal. We bought this property. If we'd have done an election, we could have saved you 100 grand. We've missed the opportunity essentially. And the second transaction bit that I mentioned there was where you buy the property in the wrong entity, and essentially later on you want to move it. So if you bought it in your own name, then you want to put it in a limited, you've essentially got all those costs to consider on the first transaction, and then again when you move it later. And often in property, transactional costs, I would have thought, of the size we're probably looking at on a commercial basis, you're probably looking at about 10% as a rough rule of thumb, whether it's stamp duty, legals, VAT, whatever it is. So if it's 10%, normally that on its own is more than enough to evidence that, do you know what I mean, it's a big enough aspect to worry about essentially. Okay, so the next one, holding companies. So They probably don't come up in discussion a lot, but they are probably more led by us speaking to clients about the risks than anything else. So holding companies are normally a consideration after a company's started up and been trading for a period. So that could be a year or it could be 5 years. There's no defined limit. And essentially, there's quite a few advantages of a holding company. So asset protection, profit extraction, risk mitigation, and a blueprint for expansion. So in terms of asset protection, it could be that, just going back to the point we mentioned, it could be that the property is bought in the holding company, not the trading company. So this is a general structure. So if you've got a holding company up here, if you're going to buy the property in there, it's at risk if that subsidiary fails. If the property's up here and this subsidiary fails, the property's not at risk. So that's quite a good example. Profit extraction. So if you've got a really profitable business and it's getting to the point where the profits in the business are more than you want to extract, that can essentially leave a lot of cash in the trading business, which again is at risk. What you can do is you can vote dividends from the subsidiary up to the holding company, and the holding company won't pay tax on those. And essentially the money then is sat in the top company, not in the subsidiary. Again, quite useful. In the top company, you could vote that dividend out to the shareholders, but if you don't need that money, that essentially can become like a piggy bank of additional cash, essentially, which back in that other structure, it may be that a dividend's paid up from there to there, and then that money from there is loaned to another subsidiary, perhaps, which is starting up, or any other entity, essentially. Risk mitigation, we've kind of touched on that in terms of if you've got a group, the risk is in the subsidiary. So if you are looking to, let's say, set up a new location or a new trade, if you set it up in the same subsidiary, both trades are at risk of each other in terms of if one fails, the assets of the other are at risk if they're all set up under, let's say, ABC Limited. Whereas if back in that structure, if you've got an IT business in Leeds and an IT business in Sheffield and an IT business in York set up as different subsidiaries, if one of them fails in a group, that won't pull any of the others down. It's also probably quite good later on for Sam in terms of it's probably easier to report as well in a subsidiary. And was there one more bullet point, Sam? Yeah, well, I suppose I touched on it there. It's a blueprint for expansion. So we've got some clients that are one business, they're looking to acquire another. And at the first instance, can you jump forward 2 slides, Sam? They're probably looking at having a trading company and buying new businesses underneath. And we're kind of saying to them, if you do that, and if this trading company fails, the original one, the subsidiary that you've just bought is again an asset, and therefore you could lose a subsidiary. If you bought it in the original structure and made it into a group where instead of that subsidiary buys the new one, a holding company is inserted above and that holding company buys the others, yeah, it ring fences the risk essentially, because that holding company won't engage with anybody, so there's no sort of risk, or it's as risk-free as it can be. So that's why holding companies are quite useful. Obviously, there is more of an administrative burden than in one company, so you wouldn't usually set one up immediately. But over time, dependent upon profitability levels, assets in the business, cash, future plans, acquisitions, etc., when you're starting thinking of those, often a holding company is a good point to have because you might only need it for profit extraction originally, but sooner or later, if you want to then acquire and you've got the blueprint there, it's much easier to start the process. If you want to acquire and you've not got the clearance for the holding company, it just adds another issue to an obstacle basically to eliminate before you can actually get the acquisition underway. So the designation will be on the activity that it does, but the main bit about holding company is the nature of where it sits in the structure, pardon me, and the fact that it doesn't actively do anything external. So what you can do is sometimes you've got a business and it buys a company, yeah, underneath it, and it wants to make the original business a holding company. Well, it can do that by moving the trade out. The problem that it's got is because that business has previously engaged with other people, there's risk in it. So it's not the way we'd expect it to be done, because if something's gone wrong and in 10 years' time they are sued for whatever reason, there's risk in it. The whole point of a holding company is it's an off-the-shelf business. It's never engaged with anybody. It's risk-free and it doesn't engage with anybody. And if anything, it may engage with management charges around the group, but not externally. The actual company itself is no different to a trading business. know what I mean, it's still set up in the same way. It's the nature of the utilisation of the business, essentially. So next one then, potential or planned shareholder exit. So this could be the exit of the founder, or in some instances, it could be the exit of a minority shareholder. So we've had a few occasions recently where there's been a very small minority shareholder from the beginning that's kind of decided that they're going to move on. Either the founders decided that they're going to move on, or they were only planning on being there for a short period of time. So quite often there's an option to do what's called a share buyback, which is often done on a minority. That can be done in basically two different ways. There's a formal clearance process, and you could do another one using a holding company, essentially. But if there's ever sort of discussions like that, if there's ever a minority shareholder that's looking to, or there is plans to remove them, it's definitely a place to have advice, because the tax treatment can vary massively. Essentially, there are certain scenarios where the buyback can be taxed as income, and others that it can be taxed as capital. The tax liability can sometimes be, 10 times, depending on the nature of the facts. One we had recently, it would have been an income distribution unless it was delayed for 6 months. So we basically gave them the option that if you want to do what you're doing, you either wait 6 months until it's tax efficient, or if you're doing it earlier, we've got to go back to the drawing board. And in that case, the deal completely flipped on its head, and the minority actually bought out the majority shareholder. But sometimes people proceed and don't realise that there's tax implications, and then afterwards again, we say there's this big tax bill that they weren't forecast for. In terms of actual exits of the founder, we normally say that if anybody's looking to exit a business, we normally say it's a long process, 3 to 5 years. That may be in terms of marketing the business for sale, or it could also be being in a sale ready state in terms of running through the process of what we normally see on a sale. A lot of founders that we speak to, not all, but a lot of them, will have probably only done this once. Sometimes we'll obviously have it where there'll be an entrepreneur who's done it 5 or 6 times, and they know the process out the back of the hand. But I think for most SME businesses, it will be they've built up a business and they want to retire, and that's it, and they probably won't do it again. So it's very much a sort of a hand-holding process, or can be. And within that, there is sometimes tax planning to do some structuring before the sale actually occurs, in terms of we may need to do it early, because if we do it right before the deal, the tax position might not be optimised. So we very much say that if that is on the horizon, let's have a long run up to it, rather than just doing it 3 or 4 months before and having a bit of a rush job. In terms of options on how to sell, there could be a traditional trade sale to another buyer. An MBO is a management buyout. So that could be management buyout that's already got equity. So from the slides earlier, if you've got 3 or 4 members of the board that's got 10% each, or a couple of percent each, they may buy out the remainder of the founder. That can be done quite tax efficiently with a clearance. Obviously, you're still negotiating, but it's a bit more friendly than obviously a trade sale where you've got a completely external business that you're selling to. An EOT is probably the most friendly. So you may have heard of employee ownership trusts. So they've been in the news probably quite a bit over the last 5 years, and John Lewis is a good model, where essentially certain businesses can sell their business to an employee ownership trust. And obviously in that instance, it's a very friendly relationship, because the founders will normally stay on for a period. The tax treatment on an EOT is 0% capital gains, which is what normally drives everybody to look at it. It doesn't suit every business. So some businesses will suit that great. Other businesses, it just is doomed to fail. But essentially, if we've got a client who's looking to sell, we will kind of go through the options and discuss with them the pros and cons of each to outline where we're heading. And if we are looking for a trade sale, we've got a corporate finance partner that's what he does every day. And I've kind of touched on the tax advice already, that essentially within this process, we'll be looking to maximise reliefs and exemptions, not just now, but for where you're heading to be in future, which may be, you may be more looking towards the next slide, which I think is sort of the wealth planning section. So the last slide then, so wealth preservation. So this may be at a startup stage, or it may be probably more likely as the business is maturing. So this could be looking to utilise any business or personal reliefs. So that may be using pensions, which could be either buying properties that I mentioned earlier. It could be just pure pension contributions to give you something for later life. A lot of times it will be looking at maximising inheritance tax reliefs. A founder wouldn't necessarily be looking at that straight away, but if they've got a plan outlined to sell in 5 or 10 years, it may be, right, I know I'm going to get between X and Y. My next problem is when I've got all that cash, I've got a huge IHT bill. So we need to think about what we're doing sort of in the next step, essentially. So that could be done before the actual sale occurs, so that we are using as much as possible over the period of time. And the two things that come up quite often are things like trusts and family investment companies. Both of them are really good, but generally the earlier that you do them, the better. So that's where the sort of the long-term plan works well. If we leave it until you've sold and the older that the person is that is looking at these, the inheritance tax, the shorter horizon that we've got, especially depending on what may come up in the budget next week. So the earlier that these things are considered, the more tax efficient we can be. So family investment company. So if I mention trust first, so a trust is basically a legal document where somebody holds assets on behalf of somebody else. A family investment company is essentially the same type of arrangement, but instead of them being held by a trust, it's held by a company. So it could be a family investment company may own property, so it could be commercial or residential. It could own shares, which could be trading business shares or stock listed shares. It could hold cash, bonds, basically anything, essentially. And that is essentially, well, both of them is essentially used for generational wealth planning. But there are pros and cons between the two in that some of them are more beneficial for flexibility. So generally, family investment companies are quite flexible, whereas trusts are quite rigid. The inheritance tax treatment changes on the both of them, but essentially that's probably, it's becoming a more and more popular option for people at the moment. That's not to say that necessarily you will use it to move any shares from your trading businesses into there. A lot of the time it will either be done on the side. So it may be that the property you want to acquire, you don't want to put it in the group, but you might want to put it in a family investment company so that as it grows in value, that you know that will be passed to your children. Whereas if it's in the group, you've still got a company. You may not want your children to be shareholders in your group company, but you may want them to be in a family investment company. You may want different people in the family investment company than you want in the group. It may be that you just put cash in there after you've sold, and then you can use it quite tax efficiently, and they can be set up quite complex or quite simple. But essentially, they will normally be used where you've got a client where they've got an inheritance tax liability, or they're at least forecast to have one. So you would often have it husband and wife and maybe kids. You could have grandkids, you could have cousins, nieces, nephews. It's, do you know what I mean, quite wide. Ultimately, it's a vague term because it's however the person wants to set it up. The only difference would be is, depending on who you want in a family investment company, if you wanted to change it later, it's quite a pain. Whereas if you've got a trust, they're more flexible in that area. So that's where the sort of planning in originally of who would you want to benefit, that may dictate which one you go for, or you could even have a hybrid. But essentially the options are limitless. It just depends on the specifics of what you've got.